this point in time, I would love to invite our very first speaker for today, in person of Mr. Eric Udokpa. Sir, you have the floor.
Thank you, Williams. And I first off want to say a very big thank you to the entire Connect Nigeria team for putting this together. And then to the audience, I say welcome to this session. I do strongly hope and believe that you will enjoy yourself, and then you will get refreshed with a bit of more information as to various options that could be used to finance emerging businesses, especially given our new normal and the challenging environment as presented to us by COVID-19. So I want to go straight. First off, let me quickly also state that I do understand from my discussion with the organizers that there could be a number of questions. So I might be just taking about 10 minutes. So I add 10 or 15 minutes. So we'll have additional 15 minutes for question and answer. Hopefully that will make the session more interactive. So I'll start off with the very first point. And my first point would be something to help us overcome the mites that we probably might have had in our mind over a long period of time. Oftentimes when you listen to motivational speakers, they tell you that you don't need to use your money when you're starting a business. Unfortunately, my first contribution here is that that's not correct. For you to be able to start a business, especially if you're a greenhorn or if you are new to the business world, you will need to be able to commit your assets. You need to be able to have some savings. So if you plan to start up a business, my advice is that you put together some assets right now, and then when it's time for you to start, you look for a way to defray those assets. If you have some you want to sell, you have others you want to mortgage, you might as well do that because that's about the fastest way compared to other means of funding your emerging businesses. Financing out of your pocket and savings is key to start up, especially if you don't have experience in the business world, if you don't have experience running a business, or if you're just new. So essentially, a few other things that you need to do is to check if you have assets that you could mortgage, if you have savings that you put away that you can call on. This will become very helpful and then help you to also quickly start up your business. And then in the second phase of your business, you can look to bring in investors to take your business to the next level. All over the world, well over 60% of startup is achieved by people that use their personal savings, mortgage their assets, or totally defray their assets to achieve this. The second point is another source you can use to fund your emerging business is family and friends. Most people often overlook this, especially given the stigma that is involved in asking people for funding. But this is actually a very good way for you to raise money, because if you can have your family and your friends to believe in you and believe in your idea and your ability to turn your idea into money-spinning business, then you might as well have twice as difficult time trying to convince other investors to bring in their money. Your friends and family are your first point of call outside your assets and your savings. So when we talk about friends and families, it could be people that you were in school together, people that you previously worked with together, your parents, your siblings, your cousins, and your extended family members. These are some of the people that you can very easily go to and then put in a request, show them your proposals and show them your projections, convince them that you can make money with it. And because of the family ties, they are more able to put that trust in you and invest in you, especially if you've lived a kind of life that impressed them and make them proud of you. There are some sticky issues with going with friends and family. And most of that is because they have easy access to you. They tend to over bother you, call you more frequently than investors probably would do, put pressure on you, wanting to know when they will expect their money, how the business is progressing. They just sort of generally knows into your business, and this is something that we want to look for a way to manage. And one of the easiest way to manage that is to ensure that as you approach them, to request for funding, you need to ensure that all such agreement that you have with them is documented. It's well documented in either in a proposal or in a business contract agreement, so that they will know what to expect. They will know what they are bringing into the business, how much they are bringing it when they are bringing such contribution to the business. They know how much they are expecting in return, and then they also know exactly what you might be using their contribution for in that business. This tends to give them some security. And then lastly, what you can also do to give them that confidence from time to time to ensure that they don't over disturb you is to give them a weekly, monthly, or periodical report, but just any sort of periodical report to let them know how the business is faring, how much progress you're making. If you have any challenges, you let them know ahead of time. If you have any possible delay that could make them not receive any tranche of the repayment, then you better let them know much earlier ahead of when such deadline will arrive. So these are some of the things you can use to ensure that when you collect money from family and friends, they don't over nose into your business, and then they don't overbug you, and you become successful also in running the business. Then another thing, another way you can, of course, finance your business is this might sound pretty straightforward, but it works. Trade credit. Trade credit or business credit is when you, for instance, you need to procure goods and services to supply to a third party, especially if you are a vendor. Your business involves you being acting as a middleman between two institutions. You establish credit line with your supplier, telling them exactly what you want to do with their product or with their goods, and then asking that they give you a period of time to repay back, so they can advance you this product and these goods at an agreed price, and then with an agreed future repayment date. So for instance, you could obtain a 30 days, which most trade credit anyway will be within 30 days. Some could be as high as 90 days, but you need to build up from 30 days, build their confidence and their trust. Then the longer you fulfill those commitments, the higher the amount of time and the longer the trade credit period they will advance to you. So essentially, you take the product from them, then you deliver it to the end user or to the buyer. Then you have up to 30 days, maybe in some cases 90 days, to collect the payment and then extend their own portion of the amount to them. So if you do this constantly and you are committed to it, they will over time have that trust in you. And then because of that trust you've built up over time, they will have confidence to continuously give you product. You have confidence to give you product over a longer period of time. This is a very good and quick way to finance a business. And one good thing is that with this method, you can cut out unnecessary interest that might accrue if you were to go to, for instance, a financial institution to advance that money. It could also help you cut out having to part with equity ownership of your business or part ownership of your business. So trade credit is a pretty good way for you to also finance your business. Then I'll go next to one of the most traditional myths that we are used to. Most people know that financial institutions, in particular banks, commercial banks, or every other form of banks, are there supposedly to support you, to support your business. But what most of us don't know is that most big banks they are not really interested in your projections. They are not interested in business startup. They would rather invest their money and give advanced loan to big businesses that are pretty doing well already, making sufficient profit, have existing assets that they can defray even if the business fail to cover the cost of the loan. So commercial banks and the big banks are essentially not really interested in startup, mostly except they are forced to do that. And you could really understand why, because you see their staffs are fancifully dressed and they want their money back in tenfolds. They also want a lot of assets for you to put against the loan. But essentially, if they are going to give you £1, $1, they want you to show to them that you have for every £1 that they give to you, that you have £10 somewhere in assets value for them. So they do this to safeguard against themselves. Remember that the money that they are giving out to you is not their money. It's most of this cash are from depositors' funds. And then for them to protect it, they will require assets. They require you to personal guarantee or get some guarantors as well. These are pretty difficult things for startup to meet because you might not have sufficient assets or be able to procure the required guarantee to make this a success. So commercial banks are there, but you should know ahead of time that if you are a startup, that this might not be the best option for you to use as a startup. But in case you're still thinking of using commercial banks, there are a few things that you should know. They most likely will ask for a business plan. They want to see your business plan. They want to see how you have outlined your business, what you project to spend and when. They want to see your financial projection. This is very key. They want to see how many fold of their money that your business will be able to return. So if, for instance, you have a financial projection that is showing that you want to borrow 10 million naira, and then in 5 years, your business would have, your projection is to make 20 million naira. That's really not an encouraging projection for anybody to give you money. It essentially shows that in 5 years, you would have only doubled the money, and that will hardly pay for the interest, pay for your running costs, and then also pay for other costs. So most times, if you want to really go to the banks, you have to ensure that your business and your financial projection is that which is pretty encouraging. And then you also need to have assets put away. You need to have maybe a valuable piece of land, a building, an automobile in some instance that you can commit to them as a lien that they can hold against the amount that they are going to advance you. Now, this explains why going to financial institutions like banks to raise money is not the best for startup. And then that essentially would then take me to the next option that could be available to you: crowdfunding. Crowdfunding these days is beginning to gain ground more and more. In Nigeria, most people now know about GoFundMe, Kickstarter, and their like. So crowdfunding is, these are platforms that enable you to put your business ideas and your business products, put a synopsis of your business on the platform, so people look at it and then realize that it's a good business idea. They look at the projections, they look at the personality and the profile of the person projecting the business, and then they decide to buy into it. So with crowdfunding, you essentially have thousands of people bringing in small amounts to support a business idea and then to turn that idea into business. With crowdfunding, there are a bit of a few things that we need to know. With crowdfunding comes the need to be visually appealing. So crowdfunding essentially is more suited for products that you can build and then put on the platform, because the people are not there with you. You know, you want to create it and create the ideas and put in visuals that are very appealing to the eyes, that people will look at and say, oh yeah, this is beautiful, this is lovely, and then they will now decide to either inquire further or outrightly make investments. And now, because most of these investments you get from crowdfunding are very small, you require a huge number of persons to have that same interest in your business for you to be able to raise the sort of amount that you need. And then also you need to be able to convince them, and then this could take quite some time. And then in some instance, you have to enter into additional negotiation with some of the investors outside what you are already offering on the platform. And then I must say that crowdfunding is more suitable for technology-related products. It is really more suited for that. And then that's why you see most people that raise money on Kickstarter, and most people that raise money on Indiegogo, they are more of technology-related ideas and projects. So essentially for crowdfunding, for you to have a successful crowdfunding campaign, you will need to be able to build what they call an MVP, a minimum viable product, or a prototype of your business idea. Now, this prototype and MVP, when you put them on the platform, the potential investors can scroll through them, go through them, demo them, see how it works, get a little bit of the feel of it, and then if they love using it, then they can as well just figure that others might also love the idea. And then because what they are expected to invest is usually not big, is what we can call negligible investment. So they can easily drop you $500 here, $100 there, and then you accumulate it, you aggregate it to a sufficient amount for you to fund your business. But the key issue with this is that you will have a lot of persons, a lot of heads, and a lot of minds to manage in terms of running the business, because all these investors will then form people that you have to deal with in running your business, sort of like an additional headache for you to bother about. So for you to, before you take the decision to go crowdfunding, then you need to also consider that this will have to be a good idea for you. Then the next option I will talk about will be angel investors and or venture capitals. Angel investors are rich, successful individuals, business people. They've probably started their businesses in the past and exited. They've made a lot of money working or building and selling businesses, and then they are just looking for business idea or smart individuals to put in their money, on, and then make excess of 3, 4, 5, 10, and 100 folds return in their business. These days, we have a lot of angel investors around, and a little bit of a difference between the angel investors and the venture capital is that while angel investors are mostly individuals, the venture capital are mostly corporate organizations that are set up to invest in business ideas and invest in smart, intelligent individuals that can also bet a business idea. A few other things that you might need to know about this is that angel investors, they make a lot of investments along with venture capitals, of course. They make a lot of investment in so many companies, hoping that one or two of them will become hugely successful, and then they will be able to recoup all their investments. So to them, it's more of a game of average. We invest in 20 highly potential early stage startup, and then we hope that one or two will make it to Silicon Valley, become a unicorn, and then we cash out from there. Also, there are many of them across various industries and niche. So really, unlike crowdfunding, where we find that most of them we want to focus on technology-related products. For angel investors and venture capitalists, there are some specialized ones that choose to invest in women and women only. There are some specialized ones that choose to invest with people with color. Others choose to invest in fintech, financial technology, agri-technology, just every sector you can really think of. You will find an angel investor and a venture capitalist in that sector. And also, they are very smart people, and because they've been successful in running their business. So these are smart people. They can contribute their ideas. They can give you route or access to markets. They can help you improve your product, and then they can guide you to become successful as well. This is some of the advantages that they would bring to your business. And then in addition, because of course they are smart people and they've been here and there in terms of the business life, they are more able to protect themselves. So expect them to build a very tough contract that will protect them, protect their investment. Expect them to always want to check your books to be sure that you are delivering on promise, and also expect them to be concerned when you are failing, because they might want to take over the management. They might want to be more involved in management. So these are some of the things that you should expect when you are drafting a contract or an agreement with angel investors or venture capitalists themselves. And then if you really want to know where you can find angel investors or venture capitalists, they are pretty much all over the place these days. They're all over the web, all over the internet. You can use any search engine. You can go to Crunchbase, you can go to AngelList, and then you can go to InvestHer. These are some of the places where you can find them. And then, like I said, also they are across industries. You can attend industry events, you can attend webinars, seminars. You come in contact with these people. More often than not, it's better that you meet them at a more relaxed environment where you are able to talk to them and have something close to sufficient time to pitch your ideas to them and get them convinced and interested in your product and your idea. But you must be ready with your pitch. That's what most of them look at. They are really not initially too out for your business plan or your financial projection. They just want that 2-3 minutes pitch, that elevator pitch that you can use to convince them, get their idea, and then they can then invest more time into your business and invest more time into coming out with the business plan, the projections, and every other thing that they need to come out with. Then I want to talk a little bit more about the features, what you should also expect in terms of working with angel investors. Angel investors are very quick investors. If you pitch and they like your idea, they will invest in your idea within a think of an eye. They really don't take much. They make investment right away. So for that, you should expect angel investors not to take so much of your time in terms of deciding whether to invest or not to invest. If they want to invest, they will invest right away, which is why, again, your pitch statement is very important that you get it right. And then the other aspect is that expect them to take equity in your business. You should expect them that they will want to take equity in return for their investment. And as much as possible, they want to take as high as they can. So if you are expecting to use an angel investor as an option to finance your business, know that they will ask for equity investment, and then know that they will want to take as much as they can. And also know that the responsibility to negotiate your part of the business is on you or on your business advisors. So I advise that you protect yourself when you are going into contract with venture capitals or you're going to contract with angel investors, because in some instances, people describe them as shark. If you let them into your tank, they can eat you up and eat up the business, and then they move ahead. If you know the story of McDonald's, most of us know about McDonald's. The McDonald's brothers really didn't make it beyond one branch. They ended up with, they were constrained because they had an investor that was interested in their products, and then they essentially sold the right to franchise their business. So once they sold that right to franchise their business, the young man took over the business, opened up a lot of franchising and around them across the whole of the United States. And then these guys were restricted to just a single branch in a branch in a single location. And then over time, the other McDonald's units, they were branded in a way that the owner's brand, the owner's unit had to comply with what others were doing. Otherwise, they would have been the odd one out. Long story short, he eventually bought not just the franchise now, he bought the name. He actually bought their family name to call his own business. So he bought the McDonald's name away from them because they really were not going anywhere. They were locked up in a single branch. They didn't have foresight. They didn't negotiate when the investment was coming in, and then that's how they lost the business. And then eventually, I think the eldest of the brother died of depression, and then the other one also was essentially forced out of the business, and they went out, and they didn't just go out. They went out without their family name. They were promised royalty again because they did not. The royalty that was promised to them was not inked in the contract. They did not earn that royalty until date. They earned nothing from that business. It's a very pitiable situation, and it was only because they really didn't negotiate and they didn't protect themselves before starting up, before signing that agreement, which initially was harmful and appeared to be helpful. But over time, it was not helpful, but it was more harmful. So essentially, if you negotiate with angel investors and venture capitalists, try and get in experienced management consultant and experienced business persons or lawyers at least that knows about business to help protect you. Don't quickly jump into signing MOU, signing NDA, and then signing business agreement because you really want to start off. So that's it for going with angel investors and venture capitalists. And that takes me to the next option. I think I'm running out of time. I'll just sum up the next three. Technical co-founders. Technical co-founders are pretty much a good and easy way for you to quickly start up your business. If, for instance, your business requires you to build a platform, build and own a platform. For instance, your business idea is to build an Uber kind of business, and then you have a technical person to partner with as a co-founder. The cost you would have spent in building that platform will then not go into that platform. We rather go into something else because your co-founder, who will now become your sort of like an investor, will take that cost away from you. And more often than not, for technology projects, the most difficult part of it is building the platform. So if you have a technical co-founder, you have the business idea, look for a technology person, a developer that can build that idea into product, then they build it into product for you. Then together with that person, instead of you paying in cash, they will now become your business partner. Then you start the business, you take the business to the next level from there. That's essentially it for technical co-founders. And you could find people like Volume 3. Volume 3 is pretty much big on that. But I think the biggest on that would be an organization which I represent in this region called Faster Capital. What Faster Capital will do for you is, beyond being your technical co-founder, they could invest up to 50% of what you need to get your business up and going. And then beyond making that investment in your business, Faster Capital will give you a letter of commitment. They have become your technical co-founder. They are giving you a letter of commitment to show to other potential investors, to tell them that I have Faster Capital as my partner. They are providing the technology bits. They are providing additional support in building the business plan, the financial projection, and every other thing. And then they are also going to continue with me to run and develop this product. So you take that letter to go meet other investors. It becomes 100% a lot easier for you to convince them to give you to give you the additional money that you need for promotion, marketing, and every other thing. I do have a few other options here, like going with business incubators and accelerators. Again, one of the biggest business accelerator and incubator around this corner is Faster Capital. But again, in this part of the world and other parts of the world, we now have more than 1,000 of them looking around. Other ways you can use to finance your ideas could be entering into competition, business plan writing competition like the Founder Boots Camp, and a lot more competitions that you have. So if you're willing to become one of them, one of the top business idea generator, they take you in, they fund your ideas, they support you to grow that business idea into a business solution and then a proper business itself. I really think my time is up, so I'll take questions from here. Williams, can you please help me coordinate the questions if there is any?
Thank you very much, Mr. Eric Udokpa, for that wonderful session. Let me move into a quick bio read of who Mr. Eric Udokpa is. For those of us who don't know him, it's very essential that we get to know our speakers very well. Mr. Eric Udokpa is the founder of Include Women and RKMG, ex-CGAB from World Bank, and presently the regional partner at Faster Capital. He's a tech evangelist at GSOP, a strategic partner at Volumetry. He's consultant at MedVenue. He's an investor, a serial entrepreneur, and a lover of everything innovative. And from the way he was talking, you could tell that he has a lot to say about fundraising, marketing and brand management, growth strategy, and the likes. Please, it was really a pleasure hearing you speak on those wonderful examples you gave. It's very the pitiable one about McDonald's, the McDonald's family. Well, we have, interestingly, some of the questions I've had is based on the fact that some people were asking me they can get the recording of your session. And the simple answer to that is yes. We're recording this event, and after this event, you will get the privilege to have the video recording and links where you can listen over and over again and watch Mr. Eric deliver his session. And while Mr. Eric was speaking too, interestingly, our next speaker on the list joined us, and very soon I shall be inviting her on board and reciting her, doing a bit of her citation. Now, another question we have, Mr. Eric, for you is it possible to illustrate a workable model using a simple retail startup business as a case study? This question is coming from Kelechi Bob James. Is it possible to illustrate a workable model using a simple retail startup business as a case study? Can we have you quickly talk on that?
Okay. Yes, I think I touched a bit of something that a model that could work for that purpose. When for a retail business, essentially, one of the easiest model would be for you to go for trade credit. Trade crediting is a very straightforward way to approach that. You form a good relationship with your supplier because you are in the retail. Across that value chain, there are other value adds. So you pick the product from one end and deliver to the other end, which is what retail is all about. So the time it takes to pick, deliver, and get paid could be 30 days, 60 days, 90 days. If you have a trade credit for 100 days or a 30 days or a 90 days, then a trade credit becomes a very easy way. Trade credit is when you take product from a manufacturer. For instance, you have a 30 days or a 90 days trade credit with a Nigeria brewery, and then you take their product and then you deliver it you take that product from Ibadan and you deliver it to someone in Benin, and then you deliver it in a period of say 7 days, and then you get paid after 14 days. This is still within 21 days. So if you have 19 days trade credit from Nigeria brewery, you would have succeeded in picking up the product in Ibadan at low cost, delivered to an end user in Benin at a very minimal cost, because you are using transport line. You can also use a similar model with the transport lines that you're using, get an understanding with them that you will pay them 7 days after they deliver the product, or 14 days after they deliver the product, such that you have taken the product for free, deliver it for free, get paid after 14 days, remit money to Nigeria brewery, remit money to your logistic business partner. Now, what people need to know is that everybody wants to sell. If I'm a producer of any goods, I want to sell it out. So if I have anyone that is coming with an LPO, for instance, a purchase order, and they want to be able to take the product and pay after a period of time. All I need is security that they will actually pay. Now, you can work in this security by bringing in a bank or bringing in a platform like an escrow, and then you can give the manufacturer, the producer, the assurance that this PO, this purchase order will not be paid to me. The money is going to be paid into an escrow account, or it's going to be able to pay into a facilitator account that we both trust. And then they will remit your part to you and remit my part to me. So also that manufacturer will want to see is that your purchase order is genuine, and then I think they will want to be part of it. I think that should explain how this will work out.
Thank you very much, Mr. Eric Udokpa. We still have some other questions, but as I said at the beginning of the program, because of our time, we might not be able to accommodate every question at every given time, but be rest assured, after the whole event, all questions asked will be answered. There will be post-event press releases that will go out answering every other question.